Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar being brought to us by Sadis Goldberg. The topic for today's session is Launch or Grow Your Private Fund Business. Now, very pleased to have with us this afternoon Ron Geffner and Dan Viola, who will be doing the presentation. Ron is a founding member of Sadis's Executive Committee and also oversees the Financial Services Group. He regularly structures, organizes, and counsels private investment vehicles, investment advisory organizations, broker-dealers, commodity pool operators, and other investment fiduciaries. His broad background with federal and state security laws and the rules and regulations and customary practices of the SEC, Financial Industry Regulatory Authority, Commodity Futures Trading Commission, and various other regulatory bodies enable him to provide strategic guidance to a diverse clientele. He provides legal services to hundreds of hedge funds, private equity funds, and venture capital funds organized in the U.S. and offshore. Also pleased to have with us Dan Viola, who is a partner of Sadis Goldberg as well. He's the head of the Regulatory and Compliance Group. He structures and organizes broker-dealers, investment advisors, funds, and regularly counsels investment professionals in connection with regulatory and corporate matters. Mr. Viola has been active in the blockchain and virtual currency verticals since 2014, and he served as the Senior Compliance Examiner for the Northeast Regional Office of the SEC, where he worked from 1992 to 1996. Mr. Viola's examination experience includes financial statement, performance advertising, and disclosure documents and reviews as well. As well as analysis of investment advisor and hedge fund issues arising under the ERISA and Blue Sky laws. So we've got quite a group here with us this afternoon. I'm going to go ahead and pass the controls over to Jennifer Rissy, who is going to be working our slides here this afternoon. Jennifer, time for you to take over. Thank you very much. And Ron, okay to begin.
Thank you so much, Cynthia. Are you able to hear me at the proper volume?
Yes, we are.
Just want to make sure. Great. So I want to first thank Cynthia. Thank you so much. I want to thank Cynthia and Interactive Brokers for sponsoring the webinar. And I want to thank those of you who are attending today or those of you who are listening today. There was a handout provided alongside the webinar that you should be able to download. And if you do not or cannot, for some reason, have access to it, please do not hesitate to reach out to either myself or my colleagues. As Cynthia mentioned, Dan and I started our careers at the SEC. Dan had examined asset managers, and I had prosecuted asset managers out of the New York regional office. While there, we gained very practical governmental experience with regard to registrants. So today's panel is Launch or Grow Your Private Fund Business. We're going to focus on hedge funds today because that seems to be the clientele with whom Interactive Brokers has considerable depth with. But to the extent you have illiquid assets or are considering a private equity or venture capital fund, our firm has significant experience in launching all those types of funds. On average, we launch about 60 to 80 funds per year. So going to slide 4. I'm going to let Jennifer catch up. We have a lot of subject matter here, but really only a limited amount of time to cover it. And I'm going to pick and choose which subjects we focus on because I'd rather go deeper into a few subjects than 1 inch deep on a broader range of subjects. So we're going to really just touch upon launching a fund, a hedge fund, what factors go into it, some of the regulatory applications, and some of the limitations on raising money for private funds, hedge funds. So we provide history of the funds on page 5 and on page 6. You're going to hop to page 6. Really what defines a hedge fund is just a private commingled investment vehicle. Commingled meaning theoretically it's designed for more than one investor. And theoretically, and I say theoretically, or generally speaking, in most funds, all of the investors are treated equally in the sense that they have a pro rata share of the same portfolio. And I say generally, we have exceptions to everything that I'm telling you, which there are times where a manager of one fund may create more than one portfolio, and then through either class or series, and then different investors within that class or series share the same rights in that class or series and have a pro rata interest in that class or series. But hedge funds are really known, and it depends on who you speak to. They're really defined by an entity or person serving as a general partner. In this day and age, it's an entity owned by one or more persons, and they receive a percentage of the profits that they generate. There's a company called Hedge, and that's how they defined it. But there's no ubiquitous definition in my mind that would define one. So let's go to page 7. When somebody contacts us, whether it's an existing client or a new client, we try and ask preliminary questions to better guide them. First is, how much money, worst case, do you anticipate you're going to raise? Now, for emerging managers, this is often called the friends and family round. For institutional asset managers who have existing funds, they may tap existing clientele, or may have been approached by existing clientele, or they're going to seed it with their own money. And then people who are leaving firms with pedigree will often have had contact with certain investors with whom they have enjoyed a warm relationship with and have a high sense of confidence that those investors are going to follow them. And we can touch base about that later with regard to employment agreements and non-solicitation requirements if a manager is working for another firm and wants to leave and form their own business. And then we also look to what types of investors, and investors fundamentally are broken into a few different buckets. First two buckets, how I look at it, are high net worth versus institutional. And then the other buckets are U.S. taxable dollars, U.S. tax-exempt dollars, and non-U.S. persons dollars. And depending on those buckets, the known or the hopeful, meaning I'm a manager and I think I'm going to launch a fund with $5 million of people that I've spoken to. I presume if I'm a manager launching with $5 million, I'm not getting into this venture just to manage $5 million. I'm doing it because hopefully I expect to attract more money. So when I said the known and unknown, that's what I'm trying to touch base or talk about. It's going through the manager's business plan, not only today, but tomorrow, like the 6 month, the 1 year, and the 5 year. What do you think you're going to start with today? Where's the money coming from? What type of bucket? And where do you anticipate attracting money from going forward on a long-term basis? And what's the thesis behind it? So it's not only that we ask you these questions and assume that your answers are correct, we try and help you gauge the accuracy of your assumptions. And the reason why, just go ahead, Dan, sorry.
Oh, sorry. I'm just going to jump in, Ron. I think it's important to note that a lot of people come to us when they want to launch a fund, and they often ask all of the same questions. Like, for example, instead of a private fund launch, should I, launch a mutual fund? And we often counsel our clients in that area because a mutual fund is just has so much more regulation than a private fund. And we find it's often easier to launch with a private fund. And then, although you're limited to the types of investors you can have, they're all accredited, for example, and instead of just the retail environment, we find that it's much more effective to go with a private fund launch. At that point, when you're raising money, it's a select group of people. The regulation is not as intense, and you can develop a nice track record that you may want to go down and use one day to launch a mutual fund or be a sub-advisor to a mutual fund. So I just wanted to point that out, Ron.
And by the way, Dan, those are great points. That came up earlier today in a conversation. People who don't have experience with U.S. regulations, but have experience in asset management, really at some times need guidance as to the differentiation between products. A registered product like a mutual fund or an investment company versus a private fund. And one of the other things that goes into this analysis, which is not covered on the slide that's present, is also the portfolio construction. What are you investing in? Where are those assets located? Are those assets liquid? And when I say liquid, one of the subject areas where we've been launching a few funds is the cannabis industry. And while there are many companies that are listed publicly, there are far more companies that are private. And so we meet a manager, we ask for the breakdown of the portfolio, which is at times really hard to do. Are you going to focus your knitting on listed securities? Is there going to be a small sampling of private investments? Will there be no private investments? Or will there be a majority of private investments? And then also, when we look at all these assets, are you trading commodities or futures? Are you investing in assets in South America? And the reason I ask those preliminary questions, if you're investing in commodities or futures, then we have to determine whether you're required to be a commodity pool operator, and we'll get into that momentarily. If you're investing, by way of example, in South America, and you have non-U.S. assets, and you would otherwise launch an offshore fund, there's a tax benefit to actually investing those assets in South America through a U.S. domiciled entity for the tax benefit. So those are some of the other follow-on questions. If you go to the next slide, please, Jennifer. So when I talk about the buckets of high net worth versus institutional, it really comes down to this slide. Under the Investment Company Act of 1940, all commingled investment vehicles would have to be registered with the SEC as a registered investment company, but for exemptions from this registration requirement under Section 3C. Now, under Section 3C, there are several sections. It's not just 3C1 and 3C7. These are the primary ones that come into play when we're talking about a traditional hedge fund. If we're doing a real estate fund, it might be Section 3C5. So I don't want everybody to think the sun rises and sets on 3C1 or 3C7. It doesn't necessarily. But the idea was 3C1 has been around for a while, and it allows managers to launch private funds with up to 100 investors. Once you hit 100 or more investors, you would have to register with the SEC as an investment company. I don't know, my memory serves about 10 or 15 years ago, Section 3C7 came about, and that allowed for funds with a greater numerosity of investors, an amount to exceed 100 investors. That amount is limited, pursuant to another body of law, to 1,999 record holders. And you're allowed, theoretically, under 3C7 under the Investment Company Act, you're allowed an unlimited number of investors without having to register as an investment company. But the catch is they have to have the suitability requirements for the investor are harder or higher for a 3C7 fund versus a 3C1 fund. For a 3C7 fund, for an investor to be suitable, they have to be what's called a qualified purchaser. A qualified purchaser, on average, for an individual is a person or entity with $5 million of investable assets. It's not a net worth test. Now, when I draw the line of 1,999 record holders, that comes from a different body of law. That's called the Securities Act of 1933, Section 12G, and that would require, if you have 2,000 or more record holders, to register as a public company. So when we're looking at this practice, the one thing that's nice is every day there's a learning curve, not necessarily for launching funds, but there's always a novel interpretation or development in rules. And it's an amalgamation of about 5 to 10 different bodies of law, which makes it much harder if you're in the marketplace and you're trying to do your homework. It does not behoove you, unless you've been practicing this area, to try and learn it today. I've been doing this for over 20 years. And this is something that takes quite a bit of time of practice and practical application and interpretation and experience.
I think that, Ron, that a lot of people sometimes get confused between Section 3C1 and 3C7 because, a lot of people will start with a 3C1 fund, which is basically going to limit you to 100 beneficial owners. And you're going to have, each one of those persons to be accredited. And, people ask questions about, well, what about if it's a joint account, and in a joint account, you can count as just one investor, or, people come up with different questions about, hey, what if I want to use my IRA and I also want to invest, from my personal account. In those cases, the SEC has allowed for certain types of qualifications so that you don't have to worry about double counting or worrying about exceeding the limit. And if you happen to have the good fortune of exceeding the limit one day, most of our clients will form a separate new fund under Section 3C7 and try to pull out some of the people who are more qualified, more than just accredited, to create another fund. So there's ways that we can work with you and help you navigate these two exemptions from the Investment Company Act.
Going to great points again, Dan. Going to page 9. So Section 3C1, we talked about it, requires accredited investors. Going to the 33 Act, the Securities Act of 1933. That body of law governs securities, whereas the Investment Advisors Act and Investment Company Act govern other things. The Investment Advisors Act, which we're going to make reference to, governs an entity or person providing advisory services. The Investment Company Act governs commingled vehicles, entities that are accepting investment from third parties in which they share a pro rata interest in a portfolio of securities. The 33 Act, the Securities Act of 1933, which I'm going to call from now on the 33 Act, governs the issuance of securities. And why do I say that? All hedge funds, all private equity funds, all venture capital funds issue securities to their investors. Whether the fund is a limited partnership, the limited partnership interests are securities. If the fund is organized as an LLC, the LLC interests are securities. If the fund is offshore, the shares of the offshore entity are securities as far as the United States is concerned. Those securities can be offered in the United States generally under Regulation D without having to register with the SEC. Regulation D has a few rules in it. The rule we're going to make reference to is Rule 506. Rule 506 precludes a general solicitation. And while there's an allowance for up to 35 sophisticated investors, for the smaller managers, that sounds like a godsend gift. But in reality, it is not. And in reality, the mistake is often made by law firms that may have a different experience in the marketplace than we do. But if you're going to offer your fund to 35 sophisticated investors, the reason why it is not practicable is because the offering documents need to be comparable to that made with a public offering. And all of the offering documents that I've seen that are feasible for private funds do not contain the requisite information to do this. And so the economics of it, meaning the cost it would take to do a public offering to allow 35 sophisticated investors in, the cost-benefit analysis won't work. The legal cost would exceed the amount of money you'd probably raise in the long term from these sophisticated investors. Plus, they're also perceived as a higher litigation risk because they don't qualify as an accredited investor. And so if you're taking $50,000 or $100,000 from a sophisticated investor who's not accredited, it probably represents a higher portion of their net worth, and thus they're going to be much more sensitive to volatility in the portfolio. So I just touch upon that briefly. With regard to 506C, 506C came about a few years ago, and we've written some articles on it if anybody wants follow-up. But it enables a manager to engage in a general solicitation, provided that they take extra steps and review information to validate that every investor is accredited. So the private funds that most of you are familiar with offer their interests in their fund through 506B, as in boy, and those subscription documents allow an investor to check boxes, and that the manager or the person who's reviewing the subscription documents to use a sense of reasonable analysis. And if they have no reason to believe that the application or the subscription documents have not been completed with misrepresentations, then that's acceptable. Whereas 506C, to engage in a general solicitation or advertise your funds, you have to go through extra steps to validate that an investor is accredited. The SEC has not stipulated these are the only ways or steps you need to go through to validate. They leave it to the manager to assess. So what we've seen is in the cases where we have clients who are engaging in 506c advertising offerings, they're asking for either tax returns or other representations by the investor's accountant or the investor's wealth manager. Going to the next slide. As I said, we look at the investor demographics. Where do they live? Are they U.S. taxable? Are they U.S. tax exempt? What's the strategy? And I'll focus on that, and then Dan, I'll take a pause when I'm done focusing on that for a little bit. I'm going to skip the next point with regard to the regulatory implications. Actually, no, I'll touch upon it, and then I'll leave it to you for the regulatory, but I'll touch upon it for the tax purposes. So there's two things. We look at the structuring of the fund, and then we look at the structuring of the asset manager and how they take on fees or compensation. So for structuring of the fund, U.S. taxable, U.S. tax exempt, non-U.S. persons. If a manager is starting with $5 or $10 million, we will probably only launch either a domestic or an offshore fund. If the manager is engaging in investment strategy that utilizes leverage, then there's something called unrelated business taxable income. So I'm running a long-short equity fund. I have $5 million in my fund, and I employ leverage 2 to 1, so I'm really getting $10 million of purchasing power. I have the fortune of taking that $10 million and doubling it to $20 million, and I'm entitled to 20% of the profits. But if an investor who's invested in a domestic fund with their IRA, 401k, any tax-exempt vehicle, and let's leave governmental entities out of this analysis, that investor would be subject possibly to taxes on the gains earned off of the leverage amounts if they invested through a domestic fund structured either as a limited partnership or limited liability company. It is not feasible to structure private funds for the most part as corporations. However, offshore, we form them as corporate entities. They're called blockers. So if we're going Cayman, Bermuda, BVI, Luxembourg, Ireland, we're going to form them as corporations. And the tax-exempt investor investing through the offshore fund would not be subject to that UBTI. So that's why it's relevant in trying to ascertain whether it's tax-exempt money. If it's non-U.S. money, well, generally there may not be, depending on the, first of all, it depends on the strategy. Depending on the strategy, if it's traditional securities, on average, there may not be any negative tax implications unless it's heavily reliant on dividend gains or real estate-related investments. But non-U.S. persons prefer to invest offshore. God forbid they die while the assets are invested in the U.S. There may be other implications. But if we're now taking in non-U.S. money, over the last several years, there's been a development in Europe called the National Securities Market Improvement. Actually, that's not NISMIA. This is AIFMD, the Alternative Investment Fund Managers Directive. Pursuant to AIFMD, if an investor is in the EU, we have to go and walk through an analysis with our clients, how they're going about soliciting investment and what steps they're taking, because there may be reasons why we will not form the fund in the Cayman, BVI, Bermuda, or other jurisdictions outside of the EU. We might look to the EU. Because that would be a lengthy discussion, we're going to leave that alone and put a pin in it. But I just want to bring it up for the purpose of indicating that not all non-U.S. investors are not necessarily treated the same at this stage or time in history. While it could change, I do not anticipate that AIFMD will be going away anytime soon. Now, with regard to structuring the management entities, if you focus on the location of the investment manager and its principals and employees, that might have an effect on how we structure the management entities. And I'll give you two examples. In New York City, if we're going to form a fund, whether it's domestic or off, well, let's say it's a domestic hedge fund or a private equity fund or venture capital fund, it's commercially common to charge a management fee and receive a percentage of the profits. With regard to receiving a percentage of the profits, in New York City, if we had the profits and a management fee going to the same entity, the manager would be subject to unincorporated business tax. That's different from UBTI. It's called UBT. It's a New York City-based tax. So in an effort to avoid UBT being assessed on any of the performance or incentive allocation, we bifurcate the management fee to one entity and the incentive to a second entity. Let's put a pin in New York. Let's say you're in Texas. There are certain taxes in Texas whereby it's referred to as a Texas two-step. In many cases, the investment manager in Texas would be structured as a limited partnership rather than a limited liability company to reduce tax liability to the manager who is either domiciled in Texas or has a partner or an employee or even a consultant. Anybody you are compensating. I don't want to create a narrow definition and have you think that they must be an employee. Somebody who you have nexus to in a different part of the U.S. or outside the U.S., we need to take that into consideration when we structure the management of these. I'm just giving you reasons why. And then finally, for non-emerging managers, for those that are institutional, to reduce self-employment tax at times, we will structure the investment manager, which is the entity that's providing the advisory services and receiving the management fee, also as a limited partnership, which saves about a 3% tax assessment, roughly. So if you're launching a 5 or 10 million and you grow to be a couple hundred million, it's not, there's no real threshold for assets under management, which is what I used to think it is. It's really if you have profit left over from the management fee, then we would recommend doing this analysis in connection with saving the self-employment tax. So Dan, I'm going to pause for a second and allow you to chip in on this.
Sure. Yeah. Thanks, Ron. The key considerations for hedge fund formation involve, not just the tax issues and the types of investors and whether you're going to be in the U.S. or outside of the U.S. Those are all very valid considerations. But you also have to look specifically at who is your primary regulator going to be. And we derive that through discussion about the investment strategy and, where you'd like to market or distribute your product. Some of our clients, want to just stay domestic in the U.S. Some of our clients want to go out into the European Union. And that's what Ron brought up, the AIFMD considerations and the directives in Europe. Some of our clients, want to, offer their interest around the world, but they don't appreciate that they really have to get guidance from every council in that jurisdiction in order to do that. It's just not as simple as throwing a disclaimer onto the offering document about, offering your interest in this, non-U.S. jurisdiction. Many non-U.S. jurisdictions have self-executing exemptions that will, be able to walk a client through. But most of the time, we also have to do some notice filings in those jurisdictions. So I typically start with an analysis of the strategy, working closely with Ron and others in the firm, trying to ascertain whether the SEC or a state regulator will be the primary regulator, and that's going to be dependent on what kind of assets you're managing in terms of the value of your what they call the regulatory assets under management, and we'll get into that as well. Or whether you're going to be primarily in a commodities-based strategy, which would mean that you're going to be beholden to the CFTC, the Commodities Futures Trading Commission, or the NFA, the National Futures Association. Typically, the commodity pool operators and commodity trading advisors are going to register with the NFA, which is the self-regulatory organization of the CFTC. Sometimes broker-dealer issues come up, very unique broker-dealer issues, whether you're trying to, pay people to raise money for the fund in your distribution. You got to be very careful. We often advise our clients just to work with FINRA-regulated broker-dealers in that area, and it gets a little complicated when you go abroad. So I think that's a good background for the key considerations. And then on the next slide, I think we go into some more detail about the regulatory overview. Jen, can you go to the next slide? We do,
actually. If you go to hedge fund structures, Dan, if we go to hedge fund structures on page 11,
yep.
What I was going to also highlight, I don't have access to the questions. They're not appearing on my screen, but I know Dan and Jennifer have seen them. If there's anything that appears relevant to what we've just covered, since I don't have access and cannot read them, I would ask if you read them, and otherwise I'll continue. And if you have Q&A, continue to send them. two of the three of us are seeing them, and we'll get to them shortly.
Yes,
sure.
Jen.
I see them.
Okay, I can go through and read some of them.
Hey Jen, I can touch this real quick.
Okay.
I can touch a few. I'll touch a few, and then let's see if there's some I missed, and then we'll continue. So somebody asked if we offer services in Singapore and structuring funds in Singapore. The answer is yes. We actually just helped a manager launch a fund in Singapore in the last several months. That has not been an issue. With regard to somebody asked a question, they'd like to open a limited liability company in the United States for investment purposes for publicly listed securities. I'll be joined by a couple associates in the adventure. Wow, that's a really long question. And the question fundamentally is, are they required to be registered as an advisor? So in short, while Dan may be drooling to respond to this, I would tell you it's a very facts and circumstances based. And so we would recommend just setting up a private call with that person to go through the details of what they want to do today, who would be involved, where's the money coming in from, how much money is coming in, and where do they plan on going with this venture. With regard to another question, are there assets under management limits for a 3C1 or 3C7 fund? And wonderfully speaking, the answer is no. There is no metric that precludes you from managing a certain amount of assets pursuant to either 3C1 or 3C7. However, once you cross a certain thresholds with assets under management in any vehicle, there's certain filings you make for the vehicle with the SEC. Dan, do you want to touch on that real quick?
Yeah, sure. It's really quite simple. I've never actually heard the question that way, but it makes sense that somebody would ask. Because the objective of a fund manager is to raise as much money as they can and to build wealth. But if you're based in New York and you have under $25 million of again regulatory assets under management, which is your assets under management plus any leverage that you might employ, then you're actually too small to register with the state of New York as an advisor or with the SEC. But if you go over 25 million of regulatory assets under management and you stay below 150 million, then you can file as an exempt reporting advisor with the SEC, which is essentially just a notice filing with the SEC. It's a modified Form ADV, which has basic disclosure about the fund. And it's a very simple filing. And then every year you have to update that filing. But it's not a registration. You don't have the burden of all the compliance books and record rules under the Investment Advisors Act of 1940. It's a pretty straightforward process if you can stay below $150 million. If you can't stay below $150 million, it just means that you have to implement a registration over the advisor, a program involving hiring a chief compliance officer and filling out a more robust Form ADV. So, both options are doable. We find that a lot of our clients start off as exempt reporting advisors, and they also file what's called a Form D for the fund itself, and they do blue sky filings from there. So, it's a very, very streamlined, controlled process for launching a fund if you're going to stay below $150 million. If you go over, again, it's not that much more difficult, but you do have to be registered.
Dan, can you briefly touch on the foreign private advisor exemption as well, please?
Sure. Yeah, we have actually a slide dedicated to that later, but basically the SEC.
Yeah, don't hop to that slide yet because I'm going to go to.
No, not yet. But just to give a quick overview for the question, if the SEC basically says that if you don't have any place of business in the United States and you're only managing money from outside the United States, they're not going to ask you to get registered unless you have over 15 U.S. clients. Now, for the fund purposes, the fund counts as one client. You don't count the investors, which is helpful. And most of our non-U.S. advisors will file as exempt reporting advisors because the foreign private advisor exemption also says you can't manage more than 25 million of U.S. Regulatory assets under management. So if you've got one client from a non-U.S. jurisdiction, that's a separate account, you're fine. You could just stay below 25 million and below 15. You have to meet both of those conditions in order to avail yourself of the foreign private advisor exemption. And you don't have to file any special notices with the SEC about it. It's self-executing. But most of our clients are launching funds abroad will file as exempt reporting advisors because they can actually manage over 150 million and not have to register because they're doing that from outside the U.S.
So Jennifer, if you can skip to slide 13, please. Question was also asked about the accreditation process and how it applies to non-U.S. persons. It does not apply to non-U.S. persons, so they do not have to go through an accredited investor requirement. That said, we also embed in our subscription documents this concept of suitability, because you really don't want to accept investments from everybody on the planet. You want to ascertain who has the requisite experience, who has the knowledge, who has the financial means to sustain an investment or a risk of loss. But with regard to the accredited investor definition, which is provided on slide 13, it's fundamentally one of two things. It's either a net worth test or an income test. Now, as you see, there's more than that, but those are the two main ones that we see. And it's provided before if you have a net worth in excess of $1 million net from the value of your home. That would make you an accredited investor. Or if you're a natural person, an individual with $200,000 of income over the last 2 years and a reasonable expectation of earning in the following year, or if you're married, $300,000 of income. And what I would say is there are a lot of questions rolling in, which we're actually really appreciative of because audiences aren't always this involved, but they're very specific to your personal needs. You can email me and I will schedule a time either to speak with you, and Dan will either join us, or we can do a Zoom call, whichever your preference, either if you want to see our faces or you're okay listening to our voices. And my email, and it's provided in the deck, but just to reiterate, if you don't have the patience of looking at the deck or you're a verbal person, it's rgeffner@Sadis, S-A-D-I-S. So with regard to, Jen, if you can skip to page 14, the accredited investor definition is in the process of being expanded upon. There's proposed amendments out there, so the laws are always ever changing. And because time is running a little tight, I'm going to move a little more quickly. With regard to the next slide, Jennifer, counting investors, meaning you're limited to 100 investors. And how do you go about determining whether an investor is one person or more than one person? And there are multiple issues that arise there, so you can't just assume using common sense. If a person has a taxable account and then has a tax-exempt account and then has a marital account, how one goes about counting those. Also, if there's a vehicle investing in your fund, whether it be a fund of funds or a limited liability company that's invested through a family office, how one goes about counting whether it's one investor or whether you look through the entity to each of its equity owners, that's part of the analysis. And it's also relevant when you're picking law firms that do this. It's not just picking a law firm that engages in a practice of securities and raising money for operating businesses. Because as I mentioned to you, you have the Investment Advisors Act and you have the Investment Company Act. And you could spend a lifetime learning about those bodies of law. And what we find is and also tax analysis. All of these components have an implication onto the structure and the operations of your business. Getting to hedge fund structures, because it's 12:40 and we've been into this for 40 minutes. Let's go to slide 20, please. Let's skip ahead to slide 20. So slide 20 gives you the sense of what's called a master feeder structure. In a master feeder structure, the manager has investors that really what's suitable for them, and the strategy is both a domestic fund and an offshore fund. Your options are really one of three in structuring a fund with those options. We can have what's called side-by-side, master feeder, or mini-master. Since this is the first slide, we're going to focus on a master feeder structure. In a master feeder structure, we structure a domestic U.S. fund, let's say a U.S. fund, which is generally a limited partnership, and that is in the left-hand side of right above master fund. And on the right-hand side, we also structure an offshore fund. It could be Cayman, Bermuda, BVI, or one of many other jurisdictions, Luxembourg, Dublin. And in those cases, the offshore fund and the U.S. fund invest all or substantially all of their assets in a master fund. And then the manager just trades a portfolio in the name of the master fund. And then the allocations between the domestic and offshore feeders, and I say domestic as a U.S. fund, are done pro rata based on the amount of assets that they have. And then the manager in most cases takes their fees from the master fund. That's that structure. If you go to slide 22, in slide 22, what you're going to see is instead of having three entities as funds, a U.S. fund, a non-U.S. fund, and a master fund that the two often invest in. And by the way, where the master fund is domiciled, from time to time also depends on the strategy. Depends on where the managers are located as well. But in most cases, they're domiciled offshore. In a mini master fund, which became much more popular in 2008 and since then, as people were trying to reduce carrying costs, it's not so much about the formation costs, it's more about the ongoing fees. We have a U.S. fund, and that U.S. fund invests its assets in an offshore master fund. Or reverse, we have a non-U.S. fund investing its assets in the U.S. fund. In this case, you're seeing a structure where you have a non-U.S. entity, a non-U.S. fund, it says offshore corporation, investing in a master fund which is domiciled in the United States. And then your other option are side-by-side fund, which is slide 24. And slide 24 reflects you have two funds. You, the manager, are managing two portfolios, most likely identically, but maybe in slightly different percentages. And the performance might be different between the two funds very nominally. And so what we do is when we look to strategy, we try and ascertain which structure is best for the manager. We look to see the relationships and distribution models that you have, also that takes those structures into consideration. And by way of example, to put it in a practical perspective, if I'm a U.S. manager and I'm employing a tax-efficient strategy, which I really have not seen much in the last 20 years, I only know a handful of clients that are currently doing it. Let's presume I'm buying Apple today. And for my U.S. taxable investors, there may be a concern with whether I'm going to be subject to ordinary income tax versus capital gains, which means I'm holding the position for 2 years. Whereas the non-U.S. investor who's in the offshore fund and the tax-exempt investor in the offshore fund are less concerned about the tax effect because they don't have that as a liability to the structure. And so we bought Apple today, and it's a year and a half, and the manager thinks that Apple has peaked. So for the non-U.S. and the tax-exempt person, it might be more logical to sell those positions today if the manager truly believes that the stock has hit its maximum price. But for the taxable investor in the United States, the manager has a significant tax savings if he or she might wait 6 months and a day to sell it. So if the manager believes that the assets might only depreciate 5% from the high, but the tax savings might be 20% or 15%, depending on what time in history it might be, they may want to hold it for the U.S. fund. And so there's a logic to having side-by-side structures there. What we've done in many cases for managers launching U.S. funds, embedded in the documents that we establish is the ability to convert a U.S. fund either into a master feeder or a mini master without having to get the consent of investors. Unless Dan has a comment, I was going to skip to the next page.
Yeah, Ron, I just
selecting service providers.
Yeah. I think it's a great description of the structures, Ron. I think I just want to address a couple of questions, just so we can grab them, because I think the people on the call on the webinar want to have some direct information about some things that I think I can go through quickly. one person says, look, I want to go through the family and friends platform that Interactive Brokers offers, and what are some of the compliance considerations. And we actually have worked with a lot of clients that go through that program. It's a great program, but depending on what state you're located in, you might have to register as an investment advisor, even if you're just recruiting accredited investors to be on the friends and family platform, because each state has their own requirements. If you're based in New York and you have fewer than 6 clients, then you can basically rely on self-executing exemptions and you don't have to register. But if you have a client somewhere else in a different state, you're going to have to evaluate each one of those requirements in each state. So those are some of the information that you'll have to address in the Family Friends program. I also like the question about the person who's in Belgium and whether or not they need a license to operate a fund. Well, if you're in Belgium, you definitely got to start with local counsel in Belgium. But if you want to manage money from U.S. people, people based in the U.S., then you have to explore the foreign private advisor exemption, which is again self-executing. And if you can limit yourself under those constraints, then you don't have to actually apply for any type of special permission in the U.S. So that's another question that came up. There was one person who was thinking about, I think, developing a real estate fund. We work with a lot of real estate funds, and in the structures Ron just described. And there is requirements for you to file as an exempt reporting advisor or register as an investment advisor. Some people try to rely on exemptions that they're not advising on securities. If they form a real estate fund, that's a slippery slope, and we can discuss that probably offline. Ron, I'll turn it back to you.
Sure. And then one other person had asked a question with regard, and Jen, you can turn to page 25 while I'm responding to the question, with regard to when do funds become more profitable than separately managed accounts. That's a great question, but that's usually not the driving force. But to answer your question, if you're a manager located in the United States, there may be economic benefits to structuring your relationship through a fund rather than a separately managed account if you're charging an incentive-based fee, because you may be taxed on the gains through capital appreciation rather than through ordinary income. The other benefit, quite frankly, is my perspective, it's deemed safer to the manager to manage a fund rather than separately managed accounts, because you'll have 10 pages of risk factors of things that can go wrong in your confidential private placement memorandum. Further, you're indemnified by the fund's assets, provided you're not engaged in gross negligence or fraud. But one thing that's really relevant, another thing that's really relevant in the analysis is, in many cases, there are people that are biased, meaning investors that are biased towards engaging in a separately managed account, and other investors that are biased towards investing through a commingled investment vehicle. And I'll try to dip through some other questions. With regard to page 25, I thought this was actually relevant. I wanted to touch upon, because a lot of times people either go online to the internet to try and select service providers and try to assess whose reputation is worthy and experience. You cannot assess a person's skill set by virtue of the size of their law firm. It's a function of how much experience do they have in an industry, and I'll tell you, or their commitment to an industry, or their commitment to an asset class. I'll touch back on something that's a little bit more extreme. With regard to cannabis, we have a client who is hiring an administrator for their fund to engage in cannabis transactions. I know the administrator. I did not know them. I know them to be a very good administrator, but I knew them to not be involved in the cannabis sector. Despite my guidance, they went ahead to proceed with this administrator. It's 2 months into the process. We're about to launch. We're at the 1 yard line, and the administrator comes out and says they're not comfortable with the investment strategy and decides not to proceed. The manager then is left scrambling for another 3 or 4 weeks to run diligence, pick another administrator, then negotiate and get into a contract with that administrator, only to miss a window from raising a significant amount of assets. Same thing happens in selecting prime brokers, auditors, and Is the firm best suited for your strategy? Is the firm best suited for your assets under management? So some firms expect a certain minimum, and depending on the time in history, that minimum may be lower. Where we've seen some of the brokerage firms all of a sudden, years later, when it's good times, tell their smaller funds that they need to leave their platform. Interactive Broker is not one of those firms. That's why I'm comfortable in saying that on this webinar. But there's some bulge bracket firms that may ask you to leave. And as a manager, if you're launching a product, it's really important to you that you build yourself a long runway to succeed and develop a track record. It may very well take you several years and a good track record to be able to raise money in a meaningful way. So you really need to work with people that are committed to your business, have a strong reputation, and that their fees match your ability to pay. Do you want to, let's skip ahead to 27, Dan, see if you want to touch on the commodity pool operators.
Sure. Yep. Commodity pool operators and considerations on page 27. It actually corresponds with a question that we received. It says, if a domestic U.S. fund is managing, excluding U.S. futures, is there any threshold that the fund can stay under to avoid CFTC registration while it builds a track record? Or perhaps CFTC registration is not overly burdensome. So I'll just use that as an introduction to this slide. Generally speaking, if you have a certain amount of assets in a commodity pool, you're not going to be able to avoid registration unless, which traditionally a lot of our clients will do, is they rely on this exemption 4.13A3, which is in the middle of the slide on page 27. And it basically describes the factors that you can rely on to avoid registration as a commodity pool. In order to rely on this exemption, you actually have to file a notice with the NFA and then renew that every year. That represents that you are able to meet these criteria. And basically, the first two are pretty easy. You have to basically make sure that you're exempt under the Securities Act of 1933. You have to make sure that they're privately placed security interests of the fund. You can't do general advertising, for example, and you have to make sure the investors are accredited investors or a little bit higher standard qualified eligible persons. And you have to meet one of two tests, which are the de minimis tests. One is a initial margin test, and the other one is a premium. Is an initial margin or premium test, and the other one is an aggregate net notional test. So in short, if you have positions in futures or options on futures and the initial margin or premiums are 5% or more of the liquidation value, you can't meet that criteria. Then you have to see if you can meet the aggregate net notional test, which basically says that if your aggregate net notional amounts exceed 100% of the liquidation value, you can't rely on the exemption. So you have to meet one of those tests. Most of our clients meet one of those tests. If you have a commodity pool that is dedicated to investing exclusively in futures or options on futures or certain forex transactions, or you use certain swaps like total return swaps, those are also considered commodity interest now. You'll have to register as a commodity pool operator with the CFTC and NFA because you can't meet those tests, one of those tests in the de minimis side. If you have to get registered, most of our clients do what's called registration light under Rule 4.7, which is the last point on the slide. And all it does is require you to make sure you limit the types of investors you have to the qualified eligible participant definition or QEP definition. And that basically, there's a lot of different ways to describe that and define it. But if you have $2 million or more of net worth, you're probably going to meet the definition of a QEP, and it's a little higher than the $1 million net worth of an accredited. And then you can basically do quarterly reporting instead of monthly reporting to investors. You still have to file what's called a PQR or a pool quarterly report every quarter with the NFA. So there are still requirements that you have to adhere to. You have to get fingerprinted, and you have to, disclose any history about discipline or employment. And then you also have to take a Series 3 license, which is a written exam, unlike the SEC that doesn't have any examinations.
And Dan, we only have like 3 or 4 minutes left, so I just want to touch on a few items for a few seconds, and this is going to be fast, but this gives you a sense of why. This is very specific to the individual. First, there was a question on costs. On average, depends on the manager, on average, we charge a flat fee of about $35,000 to launch a domestic fund or an offshore fund, plus out-of-pocket expenses. And the largest out-of-pocket for an offshore fund is offshore counsel fees. With any vendors you need, we are able to direct you, and it's not one size fits all, as you hopefully are taking away from our presentation. But we can guide you to what we believe is the appropriate group of people. If you are registering as an investment advisor to charge incentive-based fees for U.S. persons, those persons have to be what are called qualified clients. It's a slightly higher net worth test. Currently, it's $2.1 million. And as Jen, you don't have to do this, but as you go through the slides, we talk about various variables that we include in the offering documents, but they're specific, once again, to the manager based on the strategy, pedigree, and the time and history. Whether you're taking an incentive allocation versus an incentive fee, whether there's a high watermark, the management fee, what is the management fee, what is the incentive. Jen, if you can cut to page 33, please. Common mistakes, selecting the wrong service providers. Yes, you can switch in the future, but you're not hiring a group just to launch you. You're hiring a group to both launch you and help you stay in business and operate. So it's really imperative that you pick the right one. With regard to cutting corners, we've seen people make that mistake. We understand everybody has a budget. We will tell you what we think is a priority versus what is not. With regard to other common mistakes, and I talk about operating agreements, your biggest risks, from my perspective, are your biggest risk is a dispute with an investor, and that can be based on your communications, not the documents we draft, but emails and texts about either performance or steps you are going to take. It could be miscommunications via internet or website or marketing materials. All of that should be reviewed together, meaning when Dan gets a pitch deck or a tear sheet to review, to be doing it appropriately, Dan has to go through your placement memo side by side with your marketing material. And if a sentence doesn't match up between the two, it can create liability. Your second greatest areas of risk are within your own operations. It's business partners or it's employees. It's important to understand what the nature of those relationships are from a compensatory standpoint, compensation. Also, the nature of services being provided, and those should be documented. If something is assumed but not documented, that does not help either side. Your third greatest area of risk is a risk with a counterparty. Think about 2008 Bear Stearns and Lehman Brothers. Think about what might happen with fraud with regard to a counterparty. From time to time, unfortunately, we are dealing with fraud committed by a counterparty, not a routine one, but in cryptocurrency and Bitcoin, we're dealing with that right now for an existing client. And then finally, it would be regulatory risk, meaning the SEC, the NFA, the National Futures Association, FINRA, or some non-U.S. entity. So those are some of the things that you need to take into consideration. Once again, I implore you, if you have questions, I or Dan and I are happy to schedule a call with you free of charge for 30 to 45 minutes. Please don't hesitate to reach out to me, rgeffner@sadis.com. And I'd like to thank Interactive Brokers for this opportunity. And I'd like to thank each of you for participating on the webinar.
Well, Ron and Dan, thank you both very much for some excellent information here today. We are going to conclude our session, but before we do, I want to point out in the handout pane, you can access a copy of today's full slide deck and download it before you do exit today's event. By the way, we've also been recording, and both the recording and the webinar notes will be posted on the Interactive Brokers website as well. So with that, much thanks to Sadis and Goldberg for today's presentation. Ron and Dan, you did a fantastic job, and Jennifer, it was great to have you drive. You can all exit today's session using the X in the upper right-hand corner of your screen. Have a great rest of your day, everyone, and thanks so much for your interest here.